Bajaj Finserv, that's the other one in focus. The company just released their numbers. Abhishek joins us to give us a quick analysis on that one. Abhishek?
The ratios have improved for general insurance business, while for life insurance, the premium growth is pretty strong. So, consolidated basis, the total income is up 25.25% YOY and about 8.6% sequentially. The profit is up 31.6% YOY and about 1% sequentially, while the net profit after minority tax, that is up about 31.4% YOY, a decline of about 0.7% sequentially. So, general insurance business, they have reported YOY and quarter-on-quarter PAT growth for the first time in last 3 quarters. Quarter-on-quarter, if you take a look, the gross premium and net premium is actually down 1.4% and about 4.6% respectively. PAT is up nearly about 30% YOY and about 15.8% sequentially. The combined ratio, that's improved both YOY and quarter-on-quarter to 97.3%. The claim ratio, that's also seen massive improvement sequentially, coming down to 66.4% when compared to 72% in the previous quarter. AUM growth remains stable, nearly about 13% YOY and 7% sequentially. For life insurance, the premium growth is pretty strong, but PAT momentum is actually on the weaker side, just like they saw in Q3. So overall PAT is down about 45.8% YOY and about 68% sequentially. The gross written premium, that's up 12.5% YOY and about 43% quarter-on-quarter. The renewal premium is also up 26.3% YOY and about 41.5% sequentially. The new business premium, that's grown robustly by 44% quarter-on-quarter. So AUM growth, that continues to remain weak in single digits, growing at 5.8% YOY and about 1.25% on a sequential basis. Back to you.
All right, we'll go across to Mehraboon to get his view on these numbers and what do you do with the Bajaj twins. But by the way, we have Welspun India's numbers that are flashing in the screen. A smaller company. On the top line, there's a bit of a degrowth, I think, if you compare it on a year-on-year basis, though the margins are looking better at around 12.9%, as our ticker team has calculated. And that's an improvement on a sequential basis as well as on a year-on-year basis. And I've just looked at the last 4 quarters, they haven't got to these 13% odd margins. So the margin performance is positive, though on the top line, there is no operating leverage that is played out. So it appears costs have gone in lower and maybe some other measures that they have taken. That's why we're seeing a bit of a bounce up on that one. But that's about Welspun. Let's discuss the Bajaj twins. Mehraboon, what's your view? We had Bajaj Finance that came in yesterday, Bajaj Finserv today. How do you approach these stocks?
Well, I'll put Bajaj Finance first. I think super performance, overall business outlook remains strong. No complaints. Will it continue to deliver 25% loan growth as strong demand continues? Answer is probably yes, or my answer is yes. The multi-product model also augurs well for the company and it should allow it to capitalize on further growth opportunities. Strong asset quality should ensure a high 23% ROE, and those are the positives. The negatives, if you ask me, the lagged effect of rate hikes could temper margins going ahead. This is my first slight reservation. Number 2 is the rich valuations. Nigel, if you look at Bajaj Finance, I think this question was asked to me a year ago, which I think was asked to me. I think 6.5 price to book value it was. Even today it's 5.4 times price to book value. Do you really go and buy or put incremental money at this type of valuations for a company which otherwise is a great company? Answer is probably no. If you believe the Nifty, which I believe would move between 16,200 to 18,800 for the entire calendar year 2023, why should I buy a stock at 5.4 times price to book value? Certainly expensive. The risk of sustaining high growth and high multiples on a large balance sheet size also is another risk which one should understand. And at the end of it all, ultimately the incremental risk with the inevitable conversion to banking format, which will involve its own transformation of liability cost and compliance cost, is another risk factor. So Bajaj Finance, while all positives otherwise, the problem is only on the valuation part. At the present level, am I going to make possibly 8, 10, 15% returns from here over the next 12 months? My answer would be no. And this is me stating it despite clearly disclosing that I'm personally holding the shares. But there is no biased view on this. I'm just saying that the stock looks extremely expensive to me right now. I am not in a hurry to possibly go and sell my shares. Neither I'm asking investors to sell the shares. But putting in incremental money, honestly, is not a very fair or honest opinion. Coming to Bajaj Finserv, I think whatever I heard of the numbers, I think the same problem continues. The risk is of sustaining high growth and high multiples on a balance sheet which is keeping on growing. That's not very easy to come. Also, certain more restrictions have been put, or the regulators have put in some more things for companies like Bajaj Finserv. So I think the free run which some of these companies have enjoyed may not be there for too long. So they will have to reinvent themselves and try and maintain their growth. So Bajaj Finserv again is a company which I am again holding. No intention to sell it off, but certainly not a stock which I would recommend to put in more money right now.
All right, Mehraboon, what about Voltas? Any view out there? The margins are disappointing. The fear is market share losses continue. Stock is down close to around 5%. It's correcting a good deal actually from the recent peak. What's your view on it?
Nigel, if you allow me to say that I have tracked Voltas for many years, and I have never been able to convert my view into a positive one. I have been consistently negative on the stock. I think a company which has margins in single digits, and a company which was an EPC contractor also once upon a time. Now mainly it's an air conditioning company. And if you look at it, I think that when the market size grows, you look at the competition. The competition, intensity of competition is keeping on increasing. Go to a Vijay Sales or go to a Chroma and try to buy any white goods product, and you will get a whole range of products in front of you. I think just less than a few years ago, there are 3 or 4 models coming your way. There are more than 10 to 15 models coming your way. Ultimately, what counts is the service. What counts is the warranty. And there is not much to distinguish one and the other. So ultimately, what counts is the price. Now, if Voltas says, okay, I'm also serving the not the premium segment alone, but also the other segment, we need to understand that the premium manufacturers also are looking at the segment which is possibly meant for the middle class people. So competition is going to keep on increasing in the white goods sector. Voltas is in the white goods sector, and I personally believe this is one sector, the consumer electricals, the white goods sector, which I think over the next 1 to 3 quarters we are going to see some major downgrades coming. So Voltas is a clear pass, not interested at all. And even if you look at the valuation, it's at nearly 25 times FY25 EPS. Now, why should I pay 25 times for an air conditioning company in which competition is increasing every passing day? So certainly not a recommendation from my side.
Okay, don't like Voltas at these levels. You like Bajaj Finance, but the valuations are too prohibitive for someone to enter in right now. Mehraboon, we'll slip into a very short break. When we come back, we'll try and find some ideas from you, stocks which you can enter in at the current levels. We'll also invite our Alpha Manager for the day, Vinay Jay Singh of JM Financial. Stay tuned.